Nobody rushed into this. That was the first thing everyone said afterward. The paperwork was clean. The returns were steady. The people involved didn't act hungry or desperate. They acted normal. Like this was the most boring financial decision you could make. And that's exactly why nobody flinched. There was no hype cycle. No countdown clock. No, get in before it's too late. Just quiet confidence and numbers that never spiked high enough to scare anyone off. Month after month, the same result. Enough to feel smart. Not enough to feel reckless. People told themselves this was finally the safe play. The grown-up move. The kind of investment you don't brag about because it doesn't need defending. You set it up, forget about it, and get on with life. And for a while, that's exactly what happened. Statements arrived on time. Phone calls got answered. Nothing broke. Nothing glitched. No drama. No reason to look closer. If anything, questioning it felt paranoid, like accusing a smoke alarm of lying when there's no fire. But here's the part nobody noticed. The calm wasn't proof of safety. It was the mechanism. Every layer of reassurance made the next layer harder to question. Every "nothing to see here" trained people to stop checking. And the longer it worked, the more dangerous it became, because failure in a system like this doesn't creep in. It waits. Somewhere in all that quiet consistency, a line was crossed. Not loudly. Not illegally. At least not on the surface. Just a small decision that seemed harmless at the time. A decision that would later explain everything. And when the first person finally tried to pull their money out, the response wasn't panic. It was delay. Which raised a question nobody had asked before. Delay from what? Because the real story doesn't start with the collapse. It starts earlier, at the moment this safe investment was born, and the promise it quietly made that it could never actually keep. Here's what was really on the line, and nobody fully clocked it at the time. This wasn't side hustle money. This was people's backstop. Retirement accounts. Rainy day funds. The money you don't mess with because you don't get a do-over. Teachers. Small business owners. Middle managers who did everything right and just wanted something that wouldn't blow up. And the risk wasn't supposed to exist. That was the promise. Low volatility. Predictable returns. Minimal exposure. The kind of setup that made people say, this isn't about getting rich. It's about not losing. And once that idea settles in, defenses drop. People stop stress testing. Stop asking annoying questions. Stop imagining worst-case scenarios. Because worst case wasn't part of the sales pitch or the mindset. But here's the truth nobody understood yet. The risk wasn't market risk. It wasn't timing. It wasn't even fraud in the way people usually think about it. The real danger was structural. Built into how this thing worked, how money moved, how trust replaced verification. If it failed, it wouldn't fail slowly. It would fail all at once. And when that happened, there would be no partial losses. No graceful exit. Just frozen accounts, unanswered calls, and the sick realization that the safety net everyone believed in was never actually there. The victims wouldn't just lose money. They'd lose time. Years of it. Years they couldn't earn back. Plans that quietly depended on this investment holding together would snap overnight, retirements delayed, businesses shut down, families forced to reset. What makes this worse is that the warning signs were invisible unless you knew exactly where to look. And later, investigators would discover that the biggest red flag wasn't hidden. It was disguised as stability. We're going to show how that illusion was built, why it convinced so many careful people, and the exact moment when safe crossed into dangerous without anyone noticing. But to understand how all of this became possible, you have to go back to the beginning. Back to when this investment was first created, and the decision made there that quietly put everything at risk. The idea didn't start as a scam. That's the part people struggle with later. It started as a workaround. At the time, the system everyone relied on felt inefficient. Too slow. Too conservative. Money sat idle, earning next to nothing, while demand for safe but productive returns kept growing. On paper, there was a gap, and filling that gap felt reasonable, even responsible. The original concept was simple. Take capital that wasn't being actively used, pool it together, and deploy it in ways that looked low risk but paid slightly better than traditional options. Not aggressive plays. Not speculative bets. Just smarter allocation. That was the pitch. And in the early days, it worked. The first few cycles produced exactly what was promised. Steady outcomes. Predictable timelines. Clean records. No volatility spikes. No surprises. For anyone watching from the outside, this looked like proof of concept. The math lined up. The behavior lined up. The results lined up. So the idea gained confidence. What made it especially convincing was how boring it was. There were rules. Guardrails. Limits on exposure. Everything had a policy attached to it. Nothing screamed risk. In fact, the entire structure was designed to avoid the kind of chaos people associated with financial disasters. But here's the contradiction nobody noticed at the time. The system depended on everything continuing to behave normally. It assumed calm markets, predictable inflows, orderly timing. As long as money came in and out on schedule, the model held together. And because those assumptions kept being met early on, they stopped feeling like assumptions at all. They felt like facts. At some point, someone made a subtle decision. Not malicious. Not illegal. Just practical. A small adjustment to improve efficiency. To smooth timing. To keep things running without friction. The kind of tweak that gets justified by saying, this doesn't change the fundamentals. But it did. That adjustment introduced a dependency. Not obvious. Not immediately dangerous. But from that moment on, the system no longer stood on its own. It needed consistency to survive. It needed trust to function. And it needed people not to all act at the same time. What's wild is that early investors never saw this as a red flag, because the change made things feel even safer. Returns looked cleaner. Delays disappeared. The process felt polished, professional. And every successful cycle reinforced the belief that the foundation was solid. Here's the open loop nobody realized they were stepping into. The system wasn't designed to handle doubt. It was designed to handle confidence. As long as people believed in it, everything worked. The moment that belief wavered, the model had no shock absorbers. No margin for panic. No plan for everyone asking the same question at once. But in the beginning, none of that mattered, because belief was abundant. Money flowed in slowly at first, then faster. Each new dollar felt like validation. Each smooth payout felt like evidence that the original idea was sound. And every time someone considered slowing down or tightening controls, the same thought won out. Why fix what isn't broken? That mindset would later become the system's biggest weakness. Because by the time cracks started forming, the seed had already grown roots too deep to pull out cleanly. And the choice made at the very start, the one that seemed reasonable, even smart, had quietly locked everyone into a structure that could only end one way. And when that ending came, people wouldn't blame the seed. They'd blame everything that grew from it. The first wins didn't come with fireworks. They came with relief. Right on schedule, the early participants saw exactly what they were told they'd see. Statements matched projections. Transfers cleared without friction. Numbers landed where they were supposed to land. Nothing flashy, just enough to confirm that this thing worked. And that was all it needed. People didn't celebrate the returns. They trusted them. That's a big difference. Celebration invites scrutiny. Trust shuts it down. When something behaves predictably over and over, the brain stops treating it as a risk and starts treating it as infrastructure. That's when the stories began. Someone mentioned it casually at work. A friend brought it up over drinks. Not as a pitch, more like a tip you share because you don't want to sound like you're gatekeeping. It's boring, but it's solid. Nothing crazy, just steady. Honestly, I sleep better knowing it's there. That kind of talk spreads fast. What made the social proof so powerful was who was saying it. Not influencers. Not hype merchants. Normal people with reputations to protect. Accountants. Advisors. Managers. People who were usually skeptical of anything that sounded too good. When they vouched for it, others followed. And the partial truth made it bulletproof. The money was coming back. The system was functioning. The model was producing results. No one was lying about that part. But here's what nobody saw yet. The success depended on conditions staying perfect. Early inflows were manageable. Withdrawals were predictable. The volume was small enough that timing issues could be smoothed over without stress. In other words, the proof was real, but incomplete. As more people joined, the narrative hardened. Questioning the investment didn't just feel unnecessary, it felt ignorant. Like doubting gravity because you'd never fallen before. The longer it ran, the more history it built. And history creates authority. That authority started doing dangerous work. Red flags that might have mattered early on got reframed as features. Limited transparency became simplicity. Restricted access became discipline. Delays, when they happened, were procedural. Each explanation sounded reasonable on its own. And because early users kept getting paid, the explanations stuck. Here's the foreshadowing nobody picked up on. The system never faced a real stress test. No surge of withdrawals. No sudden loss of confidence. No scenario where everyone wanted answers at the same time. All the proof came from calm conditions. And calm conditions can make almost anything look stable. Meanwhile, the structure underneath was quietly adjusting to scale. Processes got streamlined. Buffers got thinner. Assumptions got baked in as guarantees. And every small compromise was justified by pointing to the same evidence. Look, it's working. By now, trust had momentum. People didn't just believe in the investment, they believed in each other. Nobody wanted to be the first to say, something feels off, because that meant questioning the judgment of everyone else involved. That's how the proof became a shield. But the early wins carried a hidden cost. They trained everyone to expect smoothness, to see consistency as safety, to confuse a good track record with a strong foundation. And when the system eventually met conditions it was never designed to handle, that early proof would do more damage than any lie ever could. Because it convinced people to stay calm, right up until calm was the one thing the system couldn't survive without. By this point, the system didn't need to sell itself anymore. Trust did the heavy lifting. Authority. The first engine was authority. Not the loud kind, but the quiet, institutional kind. The type that doesn't persuade with promises, but with posture. Titles. Credentials. Familiar structures. People recognized the language, the formats, the procedures. It felt like something that had existed long before they showed up. There were reports, reviews, processes that mirrored what legitimate, regulated environments looked like. Even when people didn't fully understand the details, they recognized the shape of professionalism. And recognition is powerful. It tells the brain, you've seen this before. You're safe here. Advisors played a key role. Not necessarily endorsing it loudly, but not warning against it either. Silence from authority figures often reads as approval. And when cautious professionals don't raise alarms, people assume there aren't any. Here's the contradiction nobody questioned. The system looked overseen, but wasn't actually being stress-tested. On the surface, everything passed. Underneath, no one was asking what happened if conditions flipped. That question didn't fit the tone. And because authority figures stayed calm, everyone else followed suit. Retention trigger, contradiction on paper, it looked vetted. In reality, no one had pushed it hard enough to see where it broke. Media. The second engine was exposure. Not hype, just presence. This wasn't front-page news or flashy coverage. It showed up in the background. Trade mentions. Industry panels. Neutral write-ups that framed it as a conservative alternative or a stable option in uncertain times. Nothing that screamed endorsement, but nothing that raised concern either. That middle ground is dangerous. Because when people see something referenced casually in media spaces they already trust, they assume the due diligence has been done by someone else. Media becomes a proxy for verification. If it were risky, surely someone would have said so. And the language mattered. Words like measured, disciplined, structured. These weren't promises, they were vibes. And vibes stick. What never made it into those mentions were the dependencies, the assumptions, the fact that everything worked only as long as behavior stayed predictable. Media reported outcomes, not mechanics. Results, not resilience. Here's the open loop that formed without anyone noticing. If nobody's criticizing it, maybe there's nothing to criticize. As time went on, the absence of bad press became proof of safety. People didn't ask, "Has this been challenged?" They asked, "Have you heard anything bad?" And when the answer kept being no, confidence grew. But confidence built on silence is fragile. And silence breaks fast. Retention trigger, unanswered question: what happens when the first negative headline finally shows up? Influencers. The third engine was the most subtle and the most powerful. Not influencers in the viral sense. No ads. No promo codes. These were micro-influencers in real life. The coworker who always seemed informed. The friend who was early to everything. The person who'd warned you against bad investments before. When those people said, "I'm in," it carried weight. They weren't selling it. They were validating it. And validation feels safer than persuasion. It triggers FOMO without pressure. You don't want to miss out. But more than that, you don't want to be the only one who doesn't get it. This is where trust went exponential. Each new participant wasn't just adding money, they were adding credibility to their own circle. The system grew not because of marketing, but because of social proof looping back on itself. And here's the dangerous part. Trust became decentralized. No single person felt responsible for questioning the whole thing. Everyone assumed someone else had already done that work. Advisors assumed analysts had checked. Analysts assumed regulators were aware. Regulators assumed the scale wasn't big enough yet. That gap, between assumed oversight and actual oversight, kept widening. Retention trigger, foreshadowing this diffusion of responsibility would later make accountability nearly impossible. The engine locks in. By now, the trust engine was self-sustaining. Authority gave it legitimacy. Media gave it familiarity. Influencers gave it relatability. And together, they created something stronger than proof, inevitability. Backing out started to feel irrational. Staying in felt prudent. Even people who noticed small inconsistencies talked themselves out of concern. Why risk looking foolish when everything seemed fine? That's how the system trained its participants, not to ignore red flags, but to reinterpret them. Delays became patience. Opacity became discretion. Consistency became safety. But the trust engine had one fatal flaw: it couldn't slow down. Once belief reached a certain level, It demanded continuity. Any disruption, any wobble, wouldn't just raise questions. It would threaten the entire structure. And the system wasn't built to handle that kind of shock. Because trust, once weaponized, cuts both ways. And the same engine that pulled everyone in would soon make it impossible for anyone to leave quietly, when the first real doubt finally broke through. At first, nothing felt different. That's what made it so effective. People checked their accounts the same way they always had, out of habit, not fear. The numbers were there. Maybe not updated yet, but that wasn't new. Delays happen sometimes. Systems lag. No big deal. So nobody panicked. In fact, the first reaction wasn't concern. It was self-correction. People blamed themselves for even thinking something might be wrong. Don't overthink it. This had worked for years. One odd moment didn't erase a track record. That's the first contradiction. When trust is high, doubt feels irresponsible. As small irregularities stacked up, the explanations got easier. A late statement became a processing issue. A vague email became a compliance thing. Each answer wasn't fully satisfying, but it was just satisfying enough to stop people from pushing harder. And pushing harder would have meant admitting something uncomfortable, that the safety they'd counted on might not be real. So instead, people adjusted emotionally. They lowered expectations without realizing it. Checked less often, waited longer, told themselves the same thing everyone else was saying, this is temporary. What's wild is how quickly the brain rewrites reality to protect prior decisions. By now, people weren't evaluating new information objectively. They were filtering it through a single question. Does this threaten what I already believe? If the answer was yes, the information got downgraded. Then came the moment that should have snapped everything into focus. Someone tried to pull out. Not dramatically. Not in protest. Just a normal withdrawal. A routine move. And instead of confirmation, they got a delay. Not a denial. Not an alarm. Just a soft, bureaucratic pause. That pause did more psychological damage than a hard no ever could. Because now the contradiction was unavoidable. If this is safe, why is access suddenly complicated? Still, most people didn't react by fleeing. They reacted by waiting. Waiting felt rational. Waiting preserved hope. Waiting meant you didn't have to face the alternative yet. And here's the realization that crept in slowly. Everyone else is waiting too. No one wanted to be the first to overreact, the first to look foolish, the first to admit they might have missed something obvious. Silence spread, not because people weren't worried, but because they were. Then reassurance came. Carefully worded updates. Calm language. Appeals to patience. Reminders of the long-term track record. Nothing overtly false. Just selectively comforting. Enough to lower heart rates. Enough to buy time. That reassurance worked because it matched what people wanted to believe. This is where the psychology flipped. People stopped asking, "Is this okay?" and started asking, "How long can I wait?" That shift matters. It turns a risk assessment into a coping strategy. Some convinced themselves that even if there was a problem, it wouldn't hit them. They weren't overexposed. They weren't the kind of person who loses everything. That happens to other people. Others doubled down emotionally, defending the system in conversations, pushing back against skeptics, not because they were confident, but because doubt had become threatening. Questioning the investment felt like questioning their own judgment. Here's the brutal contradiction. The calmer people tried to act, the more trapped they became. Because calm delayed action. And delay removed options. By the time real fear surfaced, when updates slowed, when explanations repeated, when access tightened, it wasn't fear that drove behavior. It was shock. the kind that freezes instead of motivates. People realized too late that they weren't reacting to a sudden crisis. They were waking up inside one. And the worst part wasn't the money. It was the clarity. The moment when it finally clicked that the safety they'd trusted wasn't just compromised, it had always depended on belief, not structure. That the system didn't break despite confidence. It broke because of it. And once that realization set in, there was no undoing it. Only waiting to see how bad the damage would be, and whether anyone would step in before everything else followed the same path. This was the moment it looked unstoppable. Money was flowing in faster than ever. Not in chaotic waves, clean, steady streams. Bigger deposits, longer commitments. People weren't testing the water anymore. They were diving in, confident they already knew the depth. Accounts grew. Statements looked healthy. Projections stretched further into the future. What once felt like a cautious play now felt like a cornerstone. The thing you built plans around. The thing you pointed to and said, "That part's handled." And confidence changed behavior. People stopped checking as often, not because they didn't care, but because they didn't need to. The investment had graduated from decision to background. Like a utility. Like something that just existed and worked. That's when the scale really kicked in. More participants meant more momentum. More momentum meant fewer questions. Every new dollar reinforced the idea that this was bigger than any single person's doubt. When something reaches that size, it starts to feel immune. Too established to fail quietly. Too visible to be wrong. At the top, the system looked strongest from the outside. There were more processes. More updates. More polish. Everything felt tightened and professional. If there were internal strains, they didn't leak. If there were risks, they were buried under layers of routine success. Here's the contradiction at the peak. The system was never more trusted, and never more fragile. Because scale doesn't just amplify success. It amplifies dependency. The structure now required constant smooth behavior to survive. Inflows had to match outflows. Timing had to stay perfect. Confidence had to remain intact. There was no slack left. No room for hesitation. No buffer for doubt. But none of that was visible to the people inside it. From their perspective, this was proof. Years of consistency. No scandals. No sudden shocks. Just growth. The kind of growth that feels earned, not lucky. That's when something subtle happened. Control shifted. No single person could slow it down anymore. Decisions that once mattered became symbolic. The system had momentum of its own. Even if someone had wanted to hit the brakes, it wasn't clear where the brakes even were. And that's when the most dangerous assumption settled in. Someone would stop it if it needed stopping. Regulators would notice. Auditors would flag it. Institutions would intervene. That's how these things work, right? But oversight doesn't activate just because something gets big. It activates when something looks wrong. And from the outside, nothing did. The machine was clean, quiet, predictable. Inside, though, pressure was building. Every successful cycle increased the cost of failure. Every new participant raised the stakes. Every day without incident made the eventual break more catastrophic. Still, no alarms went off. Because alarms require signals. And all the signals people watched, returns, stability, consistency, were still green. This is the part that's hardest to accept later. At the peak, there were people who sensed something was off. Not enough to accuse. Not enough to warn. Just enough to feel uneasy. And even then, the system trained them how to respond. If it were really dangerous, someone would have said something. If it were unstable, it wouldn't have lasted this long. If there were a problem, it would have shown up by now. That logic felt airtight. Until it wasn't. Because the very things that made this look unbreakable, the size, the trust, the calm, were the same things that guaranteed when it finally cracked, it wouldn't be gradual. It would be sudden. Total. And looking back, the question isn't how it failed. It's how it reached this level, this much money, this much confidence, this much dependence, without a single hard stop. How did no one pull the plug? How did no one slow it down? How did something this big, this trusted, this embedded in people's lives, make it all the way to the peak without anyone stopping it? The first crack didn't look like a crack. It looked like a delay. Not across the board, just in pockets. A transfer that took longer than usual. An update that missed its window. Nothing dramatic enough to trigger alarms. Just enough to be annoying. Day 1, people shrugged. Systems hiccup. End of quarter noise. Holidays. There was always a reason ready. And because everything else still appeared normal, the explanation stuck. Day 3, the pattern repeated. Now it wasn't just one person. A few conversations started happening quietly. Side texts. DMs. Hey, are you seeing this too? Still cautious. Still framed as curiosity, not fear. The responses came back calm. Reassuring. Carefully worded. Everything was in process. Everything was being reviewed. No urgency. No admission of a problem. That should have been the warning. Inside, though, the tone had already shifted. What looked like a small delay from the outside felt very different behind the scenes. Timelines that were once automatic now required coordination. Buffers that used to absorb friction were suddenly thin. Every request added pressure instead of flowing through. Day 5, the explanations started repeating. Same language. Same promises. Same timeline resets. That's when the first real unease hit. Because repetition isn't reassurance, it's stalling. People began checking more often. Not obsessively yet. Just more than before. Confidence hadn't snapped, but it was bending. Day 7, access tightened. Not locked, restricted. Certain actions paused. Certain options unavailable temporarily. That word did a lot of work. It kept panic just out of reach. Temporary meant fixable. Temporary meant wait. But waiting was becoming the only option. Inside, panic was no longer theoretical. Decisions that used to be routine now carried consequences. Every delay risked triggering more requests. Every update risked saying too much. The system needed calm, but calm was getting expensive. Day 10, silence stretched. Updates slowed. Responses took longer. People filled the gaps themselves. Theories spread faster than facts. Some minimized. Some catastrophized. Most did neither. They froze. That's when the countdown began. Because systems like this don't unravel randomly. They unravel when confidence drops below a certain point. And with every unanswered question, that line got closer. Day 12, the first hard stop. Not announced. Just discovered. Someone couldn't move their money at all. No workaround. No explanation. Word spread fast, not publicly, but privately. And private panic is the most dangerous kind. By now, the cracks were visible. What had once been smooth now felt brittle. Every interaction revealed strain. Every delay exposed how dependent everything had become on trust staying intact. The warning signs had been there all along. But this was the moment they stopped being ignorable. Because when a system built on confidence starts to lose it, the damage doesn't creep. It accelerates. And there was almost no time left to slow it down. It didn't unwind. It snapped. Access was cut without warning. Accounts froze mid-action. Requests stopped processing altogether. No countdown. No grace period. One moment things were paused, the next they were unreachable. Phones went silent. Emails bounced or auto-replied. Dashboards stopped updating. The system that had always felt present suddenly felt gone. Like a building everyone was inside of that just went dark. The exposure was immediate. People realized they weren't dealing with delays anymore. They were dealing with absence. No liquidity. No exits. No clear owner on the other side. What had been treated like infrastructure revealed itself as fragile machinery. Panic didn't spread slowly. It exploded. Information fragmented. Conflicting explanations circulated. Some were hopeful. Most weren't. Everyone tried to act at once, and discovered there was nothing left to act on. Behind the scenes, containment replaced operation. The priority shifted from keeping things running to stopping further damage. Systems were locked down. Activity halted. Preservation, not performance. That's when the scale of exposure became undeniable. This wasn't isolated. It wasn't a handful of accounts. It was layered, interconnected, and deeply embedded. One shutdown rippled through personal finances, business plans, and obligations that had quietly depended on this money being available. The truth landed hard. There was no controlled exit. What failed wasn't just a product or a process. It was access itself. The ability to move, to choose, to respond, gone. And in that silence, one thing became clear. The system hadn't been paused. It had collapsed. The damage didn't end with the shutdown. Years followed. Investigations. Lawsuits. Paper trails that went cold fast. Some people recovered fractions. Most didn't. And even when money came back, time never did. Plans stayed broken. Trust stayed scarred. What everyone learned too late was simple and uncomfortable. The most dangerous investments don't look risky. They look settled. They borrow credibility, routine, and calm, then use them as cover. When something feels boring, established, and unquestioned, that's when scrutiny usually drops to zero. And that's not a past problem. Today, the same patterns show up with new labels. Different platforms. Different assets. Same psychology. Same promises of stability. Same assumption that someone would stop it if it were really unsafe. But systems don't fail because they're ignored. They fail because they're trusted without limits. So the real lesson isn't about money. It's about comfort. Because the next collapse won't announce itself as dangerous either. It'll show up looking safe. And dare you to stop questioning it.